Hi everyone, Bill Lethman here for MoneyEvolution.com. This video is going to be the first in a series where I'm going to be talking all about annuities. So chances are if you're planning for retirement, you probably have heard of annuities, or maybe you've read about them. Maybe somebody's recommended to you that you purchase an annuity, or maybe you even already own an annuity. So in this video, we're going to be getting into a very in-depth discussion about annuities, talking about some of the pros and the cons of buying an annuity. There's lots of information out there, in my opinion. I think there's a lot of sometimes misguided or misinformation out there, so we're going to be hoping to clarify some of those common myths or misconceptions regarding annuities. We're also going to be talking about some of the common reasons that some people purchase an annuity, and we're also going to be talking about some questions that you need to ask or things that you need to know before buying one of these annuities. So let's dive right into it. So first of all, what is an annuity? Well, very simply, an annuity is a contract between you and an insurance company. And because annuities are issued by insurance companies, they can do things that maybe some traditional investments can't do because of the fact that they're an insurance company. So let's dive right in. Let's talk about 5 of the common reasons that some people might look to purchase an annuity. So probably the number one reason that most people are looking for an annuity is to generate some type of an income stream or cash flow for their retirement. So hopefully you've done some retirement planning. Hopefully you've kind of mapped out what some of your expenses are in retirement, and maybe you've identified some gaps. So one of the very common reasons that some people look for an annuity is to help to fill some of those gaps, because that's one of the primary functions that pretty much all annuities have the ability to do, and that's to generate some type of an income stream. These income streams can be guaranteed for a certain period of time. They can be guaranteed over your entire lifetime, or if you're married, they can even guarantee that over both you and your spouse's lifetime. Number 2 is principal protection. And so one of the things that annuities can do, again, because they're issued by an insurance company, and not every annuity has this ability or this feature, but a lot of annuities have the ability to protect you from losses in the market. So if you're concerned with a part of your portfolio about fluctuations up and down with stocks or bonds, well, there's certain annuities that have that ability to protect that. We're going to dive more into detail on that in one of the future segments here. The third reason is maybe legacy. And so if you've maybe determined that a portion of your investments are maybe likely to be passed down to your kids or to your grandkids, certain annuities have the ability to add on usually what's called a rider. Could be a death benefit rider, and that's to basically give your heirs some type of a guarantee there. So legacy feature would be number 3. Number 4 would be long-term care. Again, this would be through a rider, and these riders do come at an extra cost in most circumstances, but certain annuities have the ability to maybe pay an extra payment or an extra income stream if in fact you need long-term care, nursing home care, for example. And then finally, the last thing, and this is tax deferral, and we're going to get a lot more detail on this. I'll probably even have an entirely separate video about this, but one of the functions of annuities is they do fit into that, that tax-deferred classification for retirement planning. So if you're investing this money outside of an IRA account or a Roth IRA account, generally that's going to be considered in that same general classification. That money in the annuity is going to be locked up until you're 59 and a half. If you take your gains out of an annuity before 59 and a half, you're going to be subject to a 10% penalty, just like you would on an IRA. But also, too, you are deferring the capital gains. And so, again, that's going to be a lot more in-depth discussion about that and some of the pros and the cons of having tax deferral through an annuity versus other investment options that you might do outside of an investment account. Okay, so now let's talk about some of the things that you should be asking, or some things that you should know about pretty much every annuity that's out there. So let me clean the board here. So now let's talk about some common things that you should look out for with any annuity that you're thinking about buying. I'm going to get into a lot more depth and detail on each of the 4 different types of annuities and some of the things specifically you should be looking out for with each of those. But here I'm going to be talking a little bit more generally about some of the things you should be looking out for with any annuity that you're thinking about purchasing. So number 1 is going to be the credit rating of the insurance company that's issuing the annuity. And so one thing to note is that annuities are not FDIC insured. They're not guaranteed by or backed by the federal government. So it's going to be very important for you to look at what is that credit rating of the company that's issuing it. They're probably making some guarantees, either maybe for income or some of the protection guarantees that we talked about here. So you want to feel pretty confident that they're going to be able to hopefully meet those guarantees, meet their obligations there. Just like a lot of other fixed income instruments, they can range anywhere from AAA at the very top all the way down to C and D quality. Generally speaking, I think in our opinion, it makes sense to stick with A quality or better. You want to feel pretty confident again that insurance company is going to hopefully make their obligations there. Number two is going to be the surrender schedule and some of the penalties involved with that. So one of the things that oftentimes gets cited as a negative of buying an annuity is that people say, hey, once you put the money in the annuity, you're just going to be locked up, you're not going to be able to touch it, you're not going to be able to take your money out. And that's going to be true to some extent, to some degree there. Most annuities, though, do have what's called a free withdrawal feature, and that free withdrawal feature typically for a lot of annuities will be about 10%. And I've seen some that are higher than 10%. I've seen some that are lower than 10%, but 10% seems to be the most common one that's out there. And what that typically means, for example, is if you put $100,000 into an annuity, you could take out 10% in any year, even during that surrender period, and have that penalty free. We talked earlier about the IRS penalty, because annuities are classified as a retirement instrument, that if you take out any gains prior to age 59 and a half, you could also have an IRS penalty of 10% as well. But here we're talking about the surrender schedule for the annuity company itself. And within that surrender period, probably the most common is a 7-year surrender schedule. Again, some can be longer, some can be a little bit shorter. In fact, actually, there's some annuities now that are getting even more creative, and some don't have any surrender schedule at all. But typically, a 7-year surrender schedule might look something like this, where during the first year, if you needed to take a withdrawal and it exceeded that free withdrawal amount, you would be hit with an 8% early withdrawal penalty from that annuity company. And then generally, it's going to drop a little bit every year. And so after 7 years, you can take out any amount that you want and have no penalties assessed on any withdrawals. So quick example of this is, let's say you did put $100,000 into an annuity, and in year 2, you needed to take out a $15,000 distribution. Well, the first 10% or $10,000 of that's going to be free, and so if we're in year 2 here, you're going to have a 7% penalty on just that $5,000 distribution that exceeded that 10%. So keep that in mind. They're not quite as limiting as some people might suggest. Number 3 is going to be the fees. And so annuities, and this is another area that oftentimes gets maybe, I don't want to say exaggerated, but often gets talked about as one of the big negatives of annuities. Well, there's actually a couple kinds of annuities that don't have any fees at all. They're actually maybe built into the portfolio itself. Other types of annuities, like variable annuities, can sometimes have high fees. Variable annuities, it's not uncommon to see fees in 3 to 4% range. But again, not all variable annuities are going to have this. So you want to understand, what are those fees? What are you getting for those fees? Because we'll talk about it more in detail on the variable annuity side. You might have a basic contract fee. You also might have rider fees. You might have admin costs. You might have a lot of things that can kind of stack up on top of each other that can really elevate that. So you want to understand what those fees are. The fourth one are the investment options. And the different types of annuities are going to give you different things that you can invest your money in, but you want to understand pretty clearly what are the things that I can invest in, what is my potential for growth. You also want to look at that again in conjunction with those fees. So you say, okay, if I can, if I look at a track record of an investment within that annuity, you want to be thinking about, well, what is that cost that's going to come out of that investment, and always be thinking about that. One thing to note here, we'll talk again more detail on this as we get into the individual types, but some annuities will limit your investment options. So you might look at a list, let's say on a variable annuity, and say, hey, there's some really great choices here, I really like that. Well, because they might be making a guarantee, maybe for a death benefit or for an income benefit, they might restrict that list. They might tell you that you can only put a certain percentage of the portfolio into maybe some of those more aggressive investment options, because again, the annuity company needs needs to keep their risk down too. So it's important to understand what those investments are. And then finally, the last thing that you want to understand are what are the guarantees. And you want to understand, we like to focus on what are the minimum guarantees of the annuity. So you might be talking to somebody, they might be telling you all about this annuity. They may have run an illustration for you. That illustration might have a lot of things that, hey, this looks really great and everything, but maybe it's built off of a previous track record of an investment or something that may or may not necessarily be realistic going forward. So you understand what are the minimums that this annuity is going to pay out. If this thing didn't do anything at all, if it made a 0% rate of return, what am I guaranteed? Is there a death benefit guarantee? Is there a living benefit where, no matter what happens, I'm going to be guaranteed to at least get a certain amount every month or every year? And you really want to understand what those guarantees are and what you're getting into. So those are 5 things with any annuity that you should be looking out for before you make a purchase. Okay, so hopefully this is starting to make a little bit of sense. Okay, now we're going to get into a little bit more detail, and we're going to talk about where does an annuity or does an annuity fit into your overall retirement plan situation. Earlier, I talked about the 5 reasons that somebody might look at an annuity for a part of their retirement portfolio. So here, as we start to explore a little bit deeper and maybe help you uncover whether or not an annuity might make sense for you or where exactly it fits into that retirement picture, I'm going to be focusing primarily on 2 of those 5 reasons. We're going to be talking primarily about the income features or withdrawal features that some of these annuities have, and we're going to be talking about some of the protection features that annuities have as well. And those are probably the 2 most common reasons that we see people looking at annuities. So if you think for a moment about your entire retirement portfolio, one of the things that people talk about all the time, and you hear it and see it in all the literature, is the 60-40 retirement portfolio. And what that means when you hear people say that is they're basically talking about a portfolio that consists of 60% stocks and 40% bonds or fixed income. And that's almost the unanimous thing that we see all the time when we're talking about retirement. And so when you hear people talking negatively about annuities, and we see there's definitely people on both sides of this, but oftentimes when you hear people talking negatively about annuities, it's because, in my opinion, they're comparing it to the wrong thing. They're saying that an annuity will never do as well as an investment in the market or a growth mutual fund or the S&P 500. And I 100% agree with that statement. Annuities, in my opinion, are not meant to or intended to compete with stock market types of returns, even though some of the investments inside these annuities might be indexed to a market index like a S&P 500 or maybe in a growth style mutual fund. They're just not designed for that. But where I do think annuities kind of fit into the retirement picture as an alternative or as a possible replacement for some of that more conservative money that you have in regards to your retirement, maybe that 40% that would ordinarily be invested in fixed income. So if you think about this, and you're out there and maybe you're getting close to retirement and you're trying to figure out how you're going to make that transition from a portfolio that was designed for retirement growth or accumulation, where you're just growing those assets for your retirement, to now a portfolio where you're going to start to draw those assets down and you're going to start to take money out. And while you're contributing, the market volatility in some cases, maybe even helped you out a little bit, because as the market was going through its ups and downs, sometimes you're adding money while some of those investments are at a lower price. But when the reverse happens, you start taking withdrawals from those portfolios, something called the sequence of returns starts to have a bigger and bigger impact. If you think back to just a short time ago, back in the first part of the 2000s, we had what some people refer to as the lost decade. From 2000 to 2009, the total return of the S&P 500 was net negative for that 10-year period. So if you knew anybody that was retiring in or around that time and they started taking withdrawals from their portfolio, regardless of how much they had in the stock market, they probably saw their assets declining over that 10-year period. And now some of those people might be looking for some ways that, hey, I still think I'm going to live a long time. how am I going to make this money last? Will this money last? And that's the other issue that we see all the time too, is the fact that we're all living longer, and that's a good thing. And we're living longer, we're living to be healthier, so we're more active as we get older as well. And so our need for more income, even in the later years, is maybe completely different than it was for your parents or for your grandparents that maybe tended to not do as much as they got up into those later years. So now let's talk about this as a replacement for bonds or fixed income. So if you think about what generally we are looking for that fixed income or bond piece of our portfolio to do, is really primarily two things. Number one, especially for those of you that are going into retirement, is you're looking for some type of a regular stream of income. In fact, actually, we've seen study after study that actually defines those people that are happiest in retirement are those people that have regular streams of income. They refer primarily to Social Security and to pension benefits as covering a big majority of their expenses, but annuities and other things like dividends or fixed income payments also kind of fit into that category as well. And then the second thing that bonds can do, and our annuities as a replacement for bonds, is offer some type of protection. And so again, one of the reasons that a lot of people recommend this 60-40 split here is to balance the risk. So if the stock market has a big decline, by having a portion of that in bonds, theoretically bonds are going to be safer than stocks and are either maybe going to go up in value as the stock market is falling, or they're going to at least maybe not go down as much as the stock market in a circumstance like that. So how does this all look, and why maybe should you be considering an annuity? Well, if you're in your 20s, 30s, 40s, maybe even in your 50s, you probably don't have any big need for an annuity, because what we're talking about here is, generally speaking with annuities, we're generally going to give up some of the upside potential that we might be able to earn, either because maybe some higher fees, or we're going to get into it, but on like index annuities, there's some caps or limitations to the growth. But there's going to be some limitations to the amount of money that you can make in exchange for some type of a protection. So that could be our downside protection, like we're talking about here. Certain annuities are very good at that. But it also could be the income protection. And again, every annuity has the ability to pay a guaranteed income stream over time. And so again, that's what most people, or a lot of people, are looking to do, is how do they transition their portfolio from a growth mode into a withdrawal mode. But if you're getting close to retirement, if you're approaching 60, into your 60s, and now you're looking to do this, that's where an annuity we think fits and is a possible alternative to these other fixed income options. So anyway, that's it for the introduction. This was a little bit longer video, but I wanted to get into a lot of detail here, just a kind of a high-level overview. Again, if you look down below in the description, we're going to have links to the other videos in the series. So I'm going to have a video about each one of the 4 types, and then we're going to, I think, have some add-ons too. We also did some videos a little while back too, so we'll put some links to those in the description as well. So if you're thinking about an annuity, you want to learn more about them, maybe you already own an annuity, you want to understand it a little bit better, I think you'll find some pretty good resources there in the description below. So with that, I'll see you back in the next video in the series, and we'll see you then. Thanks.